Dan untuk membahas terkait dengan hal ini, kami sudah terhubung bersama dengan Thomas J. Hess, Chairman and Managing Member Great Hill Capital from New York, US. Hello, Thomas. How are you doing?
Hi, Sasa. Thanks for having me.
Thank you for joining us today. As we know, several central banks such as ECB, the Fed, BOE, and also the Swiss Central Bank raised their benchmark interest rates by 50 bips. So how investors see the impact of those central banks' policy on the capital market and financial market?
Well, the market sold off immediately following the Fed's press conference. It certainly didn't like it. But the first move in equities following an FOMC meeting is often the wrong move. They pushed the terminal rate from 4.6% to 5.1% with their dot plot and with their forward guidance, and the market didn't like that. That's what caused the market to sell off. So I think when you look at all of the conditions, the market didn't actually believe the Fed because the two-year yield closed the week at 4.18%. That's below the Fed funds rate, which is now 4.25 to 5%. And then you also saw the 10-year yield was down to 3.48% closed the week. So it's actually pricing in a possible slowdown from all the tightening that we've seen over the last 9 months. So I think when you put everything into perspective, Sasa, we saw the CPI, the inflation print, come in at just 0.1% month on month. If inflation continues to trend like that, by May of next year, our headline inflation could be below 3%. And I think the market is starting to sniff that out. And even though the Fed is being very aggressive and very hawkish with their talk, as you can see from the bond market's not believing it. And as a result, we think that moving forward, we may have a maximum of one more rate hike in February of 25 basis points, and then they'll hit the pause button. That's the good news. The bad news, Sasha, is that they're not going to give us notice ahead of time. They're not going to say, we may pause after February. They're going to continue to talk hawkish moving forward because they want to bring down long-term inflation expectations, and they've been very, very successful in doing that. If you look at the 5-year inflation break-evens, they're currently below May 2018 levels. They closed the week at 2.14%. If you remember, the Fed is always talking about wanting to get to 2% inflation. And in May of 2018, they were 2.16%. So their talk is working, their hawkishness is working, but I do think that they're going to have to pause in coming months as the data comes in order to maybe navigate us to a soft and shallow landing.
Okay, so the market see the hawkish of central banks and also the terminal rate to 5.1%. And Thomas, some analysts and economists estimate that the increase in the benchmark interest rate is a sign that a global recession imminent. So how far do you see the threat of a global recession in the United States and how it will affect on Indonesia's economy?
Yeah, well, I think, if you look back to the last time we had an inflation scare like this was 1982, and the S&P 500 dropped 27% during that period. Inflation was in double digits. This time, the S&P 500 dropped 25% peak to trough. But here's what happened. Volcker, who was the Fed chair at the time in 1982, was very hawkish. He raised rates very, very quickly, just like we've seen in the last 9 months. But on October 5th, 1982, while inflation was still near 7%, he said the magic 3 words. And he said, we may shift tactics. Okay, with no notice, he said that. And within 4 months' time, all of the losses in the S&P 500 were recovered within 4 months. Once he made that shift in language, and I think we could start to see that as quickly as February as the data comes in. So the other thing to keep in mind is many analysts and strategists are saying that the stock market is going to go lower. It's going to make a new leg lower because earnings are going to come down because we're going to have a global slowdown. But if you look at the last 6 cycles since 1957, If you believe that's true, if you believe earnings are going to come down another 10 or 20%, historically, the stock market bottoms 6 to 12 months before earnings bottom. And here in the US, with the S&P down 25% peak to trough, the NASDAQ down 35% peak to trough, we believe that the market's already priced in a lot of that slowdown already. So we've been in the market looking for high quality companies that are on sale. As it relates to how that's going to affect Indonesia, I do think that the pathway to a soft landing is narrowing, but still possible if the Fed is wise enough to pause early next year, provided the data over the next 2 months starts to confirm what we're seeing, and that is that inflation is rolling over aggressively, that the economy is slowing, and if they can pull that off, we could see a similar scenario to 1994 to 1995, when they had to tighten pretty aggressively, about 300 basis points in the Fed funds rate, but they realized that they were having the impact that they desired, and they quickly paused. And the moment that they pause, what you see on average is that the 12-month return since 1954, there have been 13 instances. The average 12-month return for the S&P 500 is 14% just 12 months later after they pause. So I think that the other thing that has people a little bit worried about a recession is the guidance that they gave on the unemployment rate in their forward guidance last week. They expect 4.6% unemployment. We're currently at 3.7%. So what they're effectively saying is they intend to tighten things to a level that another 1.2 million people lose their jobs. I think that's a little bit aggressive, and I think that they'll probably have to pause their activity before reaching that level. So we're hopeful there's still a narrow path for a shallow landing, a soft landing. And if that's the case, I think emerging markets are exceptionally well positioned. The other thing is that as they pause, the dollar is going to continue to come down, which is going to be very, very helpful for emerging markets.
Okay, what an interesting dialogue, but we have to continue our discussion after the break. So, dan pemirsa jangan kemana-mana, tetaplah bersama kami di Closing Bell. Anda kembali menyaksikan Closing Bell. Kita akan kembali melanjutkan dialog bersama dengan Thomas J. Hess, Chairman and Managing Member Great Hill Capital, langsung dari New York, Amerika Serikat. Thomas, as we know, December is the seasonally strongest month of the year. But interestingly, the main indexes in the Wall Street have been slowing down in the past week. So how do you see the volatility in the U.S. stock market? Do you think the Santa Claus rally will happen in this year?
I actually do. I'm in the minority. I think Santa will come to town. I do think we have to keep in mind that the S&P 500 was up over 16% from the October lows going into December. So we had a very big rally going into early December. And then we've given back since the Fed about 5%. So they definitely talked the market down. I think what you're going to see here is the seasonal strength that often happens. The first half of the month of December is often weak. The second half tends to be strong. And I do think that Santa may kick the Grinch out of the sleigh. The Grinch is trying to steal all the presents, but I think Santa will prevail. And I do think you'll see some bid into the end of the year. Positioning is simply too bearish, Sasa. You have cash levels for institutional managers currently at the levels of the pandemic lows in 2020 and also the March 2009 lows of the great financial crisis. And usually when you see positioning get that extreme and that bearish, no one's positioned for any good news. And I think as the bid starts to come in the second half, as it does seasonally, managers will buy into year end, and the second half of December should be a lot better than the first half, which was pretty weak with all the hawkish talk from the Fed.
Okay, so you are still optimistic that Santa will come to town. Thomas, as we know, if we're looking at even the Fed already hiked the interest rate, the yield on the benchmark 10 years U.S. Treasury is still appealing. Is that a signal of portfolio rebalancing from stock market to Treasury?
Yeah, well, I think people are really overweight. As a matter of fact, they're more overweight bonds to stocks than they've been since March of 2009. And usually that is not sustained. I think when people are flocking into the 2-year Treasury, it's yielding 4.18%, which sounds like a big deal. But when you consider net of inflation, it's a negative yield. I think as more and more people move into equities following the seasonally weak period in early December and start to buy into the end of the year, more and more managers are going to have to put some of their cash to work and come out of their bearish position. Just to give you an idea, the AAII bearish percent survey, this measures retail sentiment, only 24.7% are bullish. Historically, that coincides with near-term bottoms in the market. I think when you look at cash positioning, when you look at expectations for a recession, they are the highest since April of 2020 and March of 2009. And if you remember those 2 months, they were right to be worried about a recession, but the bottom of the stock market was already in. So even if you think the economy is going to get a little bit softer in 2023, which we do think that the stock market priced in a lot of that pain in 2022, and it's the time to be selectively buying high quality businesses that have been marked off, in many cases marked down 50% and more. And there's opportunity moving forward. We also think that the biggest opportunity in 2023 and 2024, as the dollar starts to weaken, are going to be in emerging markets.
Okay. In the past week, if we see that some of emerging markets countries, such as Indonesia, are starting to be flooded with foreign capital inflow, is this an opportunity for investors in emerging markets? And how appealing is Indonesia's financial market compared to other emerging market countries?
Yeah, well, I think this is the biggest opportunity moving forward, Sasa. Both Indonesia and emerging markets as a whole. If you look at the basket, emerging markets are trading at 15-year-ago prices. They're trading at 2007 prices. When you consider the amount of GDP growth, that doesn't make a lot of sense. Now, historically, emerging markets trade opposite to the US dollar. So when the dollar stops going up, as it did just 2 months ago, and it also did in 2002, 2009, 2016, and 2020, what you see is these very, very aggressive rallies in the emerging markets basket after a period of long depression. Like, emerging markets have been in a long depression. I think we're going to see a big rally. If you look at 2002 to 2007, you saw a 480% rally in emerging markets after the dollar started to weaken. The same thing happened in 2009 to 2011, 189% rally in emerging markets. In 2016 and 2018, what happened? The dollar weakened and emerging markets were up 96%. And then again in 2020 to 2021, dollar weakened, emerging markets were up 97%. We've had the dollar weaken 10% in the last 2 months. We think that's going to persist as the Fed starts to finish its tightening cycle. And we do think over the next 2 years, emerging markets is the place to be, particularly with the China reopening. And Indonesia is going to be a major, major beneficiary of capital flows.
Okay. Last but not least, just in a brief, Thomas, what our investors can expect navigating the markets in 2023?
Yeah, I think the biggest thing that market participants should start to do is really pay close attention to emerging markets and start to get some allocation there, because as that dollar weakens, money's going to move in. I think most strategists and analysts are underestimating the impact of the abrupt reopening that we're seeing in China. There will be some fits and starts because obviously they're going from zero to fully open overnight. So you're going to see a lot of people infected in the short term and coming out of work in the short term because they'll take a few days to a couple of weeks to feel better. But as we look out 2 and 3 months, all of that GDP is going to come back online. And if you look at the meeting last week, they set their GDP target for 2023 at 5%. And they're going to really focus in on the internet platforms and driving consumption. And if you consider that they're the largest weight in the emerging markets index, as China starts to do well, all of emerging companies are going to do well because those capital flows are going to come into the emerging markets basket, and companies like Indonesia, the world's third largest democracy, are going to get a tremendous amount of those flows. So I would be focused on, if you're not allocated to emerging markets, China, Indonesia, some of the fast growing Asian countries, you're going to miss out in 2023, 2024 is our view. And as price starts to go up, opinion follows trend. You're going to see more and more institutions coming back into emerging markets. And I think we can expect multi-year bid for those assets moving forward.
Well, what an insightful discussion. Thank you for your time, Thomas D.